So in the last Tranche Talk, we discussed the seasonal pattern that exists in ABS trusts, where we see delinquencies and defaults ramp up after the holiday spending period, only to come down after tax refunds are distributed. Now, the real stress window was in 2022 to 2023, when inflation hit hard and Fed rate hikes started filtering through the economy. But since then, the broad performance story has been more about stabilization in these metrics, not necessarily a fast return to pre-COVID delinquency and default levels. This year, we were hoping that we'd see a larger cure rate versus the prior couple of years due to that increase in the tax refund expectations from the One Big Beautiful Bill. And so for context, how large was that refund boost? According to IRS data, the total refunds paid so far in 26 are up about 18%, or 50 billion versus last year. And this translates into an average refund size of about up 11%, so $325 versus last year. So with that as a backdrop, and now that the April remittances are in, what is the bottom line so far for this year? Well, we've been a little underwhelmed with how delinquencies and defaults have responded to the additional refunds. So let's dive into what we've seen so far in the data. So we looked at 5 types of debt in the ABS market to get a monthly read-through on the health and the performance of the underlying borrower across both prime and subprime cohorts. And we compared delinquencies and default rates at the end of October 2025 and December 2025 with the latest April data, and took a look and observed the changes. So the first thing we looked at was subprime auto. Now, delinquencies are down about 10 to 12% versus the prior 3 and 6 months ago, which is in line with the drop that we saw in prior years. Defaults are about flat, which is also in line. Unsecured consumer loans, delinquencies were down about 2 to 4% versus 3 to 6 months ago, which is also consistent with past experience. Defaults, however, were up about 12 to 18% versus 3 and 6 months ago. And that's a little worse than last year when the same comparison was closer to flat. Credit cards delinquencies were up 2 to 5% versus 3 and 6 months ago, which is again in line with past experience. Defaults, however, were up about 10 to 15%. It's broadly in line versus last year, but the cure rate we were hoping for in credit cards did not really materialize. Turning to the prime segment, prime auto delinquencies were down about 14% versus 3 and 6 months ago, again, in line with past experience. Defaults were up about 14% versus 3 months ago, and up 3% versus 6 months ago, which is a bit of a mixed bag versus prior years, but still, it's somewhat disappointing because of the higher income, higher FICO borrowers. We expected them to receive a good chunk of the extra tax return dollars. Turning to private student loans, delinquencies and defaults were roughly flat. Year over year, defaults are still filtering through. So when we looked at that, it was up about 24% versus last year. So, one additional observation on student loans, last year the delinquencies were up about 12% after the holidays. This year they're flattish. So for those earlier delinquencies, they do appear to be translating through into defaults, and they're up about 6% versus last year. So that's admittedly a lot of information, a lot of data all at once. So let's boil it down. After looking at all of this in the aggregate, the big picture is that across all the set of metrics that we look at, which is about 10 data points across 5 different debt types, only 3 or 4 of those are looking to be flashing yellow at this point. Delinquencies across product types are broadly flat to down versus the preceding 3 to 6 months, which is in line with last year's experience versus 2024. So it's a good sign here. Defaults, however, are still creeping higher in several areas, around 10% this year and slightly worse than last year. Where we're most focused is the numbers that I mentioned around consumer unsecured loans. Those defaults are running hotter than last year, but it shouldn't come as much of a surprise, as these are also the furthest down the payment priority stack for most borrowers. So coming into the spring and the summer months, we do have a bit of a challenging macro backdrop. As I mentioned, year over year delinquencies are continuing to stabilize, but the cushion is thinning. The personal savings rate has fallen from about 5% in March of last year to about 3.6% most recently. Bank of America deposit data shows that savings and checking account balances usually rise around 9% between January and March. And even though those refunds that I mentioned were higher this year, the increase in deposits is pretty much flat with the last 2 years. So what does this mean? Consumers are absorbing the pressure from tariff pass-throughs and higher energy costs by dipping into savings. Inflation-adjusted wage growth looked healthy on a year-over-year basis, but the latest month-over-month figures took a bit of a hit with energy moving higher. And to be sure, energy is the swing factor here right now. The duration of the Iran conflict matters a lot. If we see $5 gasoline over the summer, that could mean that demand destruction is coming rather than consumers simply continuing to draw down further savings. So the big so what? We turned somewhat more cautious on lower FICO, lower income borrowers. Balance sheet healing has not been as robust as we thought it would be so far in 2026. We're staying constructive on the prime consumer, the prime borrower, roughly the top 20% of households. That is definitely driving a disproportionate share of consumption in the US. Having said that, though, lenders have been exhibiting a degree of constructive pessimism. And what I mean by that is they're keeping credit boxes tight. They're not loosening their lending standards. So some of the worst borrowers are not making it into the ABS trusts. In terms of how that translates into the ABS market, with energy and gas pricing still rising, we are remaining up in quality on consumer-related collateral. So to wrap it all up, the seasonal pattern delinquencies is behaving as expected. We're not seeing a broad-based consumer credit breakdown, but defaults are still edging up. We're hopeful that with elevated tax returns versus last year, we could have seen more curing, but thus far we've been a little bit disappointed. So the margin for error is smaller with savings rates lower, energy risk is higher, and as a result in consumer ABS, we're biased towards higher quality issuers and bonds with ample credit support to withstand any further deterioration.